Part of the reason why index funds are great is because it can help you outpace inflation over time. If you're earning a stock market return that is higher than the rate of inflation, then your money isn't losing its purchasing power. They are well diversified. Index funds are also relatively low cost in comparison to other funds, and they take all of the guesswork out of it. Today, we're going to talk about how to invest in index funds and why. Index funds are basically just a basket of stocks. It means that you get a whole bunch of securities in one, and you don't have to go about picking and choosing different investments to include in your portfolio. Now, one of the reasons why this is really attractive to investors is because it makes it really easy to build a well-diversified portfolio. Before we get started, I'd just like to remind you, I am not a financial advisor, and this is not personalized investment advice. To understand what an index fund is, we kind of have to understand what a market index is. Now, a market index is a collection of stocks or other securities that is already tracked. So for example, the S&P 500 is a collection of 500 of the largest US companies. And if you have an S&P 500 index fund, that index fund will perform roughly as well as that collection of 500 stocks that make up the S&P 500. Index funds can track small, medium, or large businesses. They can track US businesses or international businesses, and some even focus on particular sectors like healthcare. The first step is that you'll need to pick an index that you want your fund to track. Now, the S&P 500 is not the only one out there. There are lots of them, including the Dow Jones and the New York Stock Exchange. You can use NerdWallet's page of the best index funds to get some ideas. Your next step is to select an actual index fund. Now, aside from the index that you want to track, a lot of this decision is going to come down to cost. So an important thing to look at is a fund's expense ratio. This is a fee that's charged as a percentage of assets that you have in the fund. So a 1% fee will equate to about $1 on $100 in the fund. Now, you can find expense ratios that are as high as 2%, but if you're really looking for a low-cost index fund, then you'll look for one that's 0.1% or even lower. You can find an index fund's expense ratio listed in its prospectus, which you can look up on your broker's website. And speaking of brokers, step 3 is figuring out where to buy your index fund from. So if you're looking to invest, you'll need to have what's called a brokerage account. Now, you can open these through an online broker or an in-person broker, but it all boils down to the same thing. If you put money into an investment account, no matter what type of account it is, you're not actually invested in anything yet. Now, there are lots of different types of investment accounts, like a Roth IRA or a traditional IRA, or even just a regular brokerage account. And it doesn't matter which of these investment accounts you have, but you'll need to fund it before you can actually start purchasing your investments. According to investing legend Warren Buffett, the average investor need only invest in a broad stock market index to be properly diversified. But you can easily customize your allocation if you want additional exposure to specific markets in your portfolio. So the next thing after you put money into your investment account is you actually need to purchase shares of the index fund. And you can find these through your brokerage. A lot of them have a great search functionality. So you can just type in names of different index funds or different indexes to check out the different funds that are available. After you do that, you'll need to figure out how much of the actual index fund you want to purchase or how many shares. Now for this will be mostly determined by your budget. So if you have $1,000 that you want to invest in an index fund and the fund is selling for $100 a share, you'll be able to purchase 10 shares. There are a lot of reasons to invest in index funds, one of which is that they are relatively low cost compared to their actively managed counterparts. Now, in the active versus passive debate, we have to understand what this actually means. So an actively managed fund, like a mutual fund, has a fund manager who is picking and choosing all of the individual stocks that go into this fund. And that costs a lot of money to pay that person. And truth be told, most of the time, these fund managers are not predicting the market correctly. So these active funds not only cost you more, but they actually tend to underperform passive index funds over the long run. In a Morningstar study, only 26% of all active funds topped the average of their passive rivals over the last 10 years. So in the end, investing in active funds is more work and more money for less gain. So a lot of people wonder if it's more advantageous to invest when the market is down versus investing when the market is up. And while there is some truth to this, like if you invest when the market is lower, you get more shares for your dollar than you would if you just invested when it was higher. That being said, it's really, really difficult to time the market and people are notoriously bad at it. So just getting your money in is the most important thing. And investing over time is great. It's a strategy called dollar cost averaging, and this can help you even out the highs and lows of the stock market as you go. Investing early can help you take advantage of compound interest, which is basically just the interest that your interest earns. So the longer you have, the more your money can grow. One of the best things about index funds is that you can really set it and forget it. As you purchase them and you have them growing in your portfolio, you really don't need to be checking on their performance every single day. If you're a day trader and you like to check on the performance of your stocks, that's one thing. But if you're like most people who just want to grow their money for retirement, index funds are great because they're pretty hands-off. And just because you invest once, so if you invest $1,000 right now, that may not be enough to cover you for retirement. And in fact, it most likely, almost certainly will not be enough. So what's really important is to make investing a regular habit. So taking a portion of your paycheck and putting it towards these investment funds. Day trading may be sexier, but investing in index funds can really help you build wealth over time with a well-diversified portfolio that is closely tracking market returns. My name's Alana Benson. I'm an investing writer for NerdWallet. If you want to learn more about investing or you're new to it, you can listen to our How to Invest 101 series on the Smart Money podcast. And if you like this, be sure to like and subscribe.